individual. Okay, but you could still be using each other's rationale for a different stock, right? So once you get the rationales down, once you get the rationales for the trading, and there's not a lot of them, right? Once you get the rationales down, you can apply them to the other stocks. So once you get a template of a rationale, you can copy and paste that rationale into another stock trade. Does that make sense? So the 10-day crossed the 50, the 30-day crossed the 50, that's basically the buy or the sell alert based on moving average crossover, technical system. We recommend we're going to buy, X number of shares of this stock. That rationale, once you get it boilerplated, you can move it across the, the other stocks. And then you guys are in a really good position too, because the earnings are getting ready to come out. So for your stocks, what you want to do is you want to be looking for any pre-releases for your stocks, and then definitely you should be trading right when the releases are made, right? Right when the releases are made. If they miss their estimates, then you probably want to short. If they beat the estimates, you want to buy. So you should be buying and selling on the news, on the earnings estimates. Okay, so you need to start tracking the. Yeah, go ahead.
So for the class portfolio, do we need to trade the stocks that are in our portfolio?
Not necessarily.
Okay.
You don't need. I mean, I was just going to make it easier for you to just trade the ones that you pick, but you could be trading anything else. I don't care.
What?
But it's got to be at least 25 stocks.
Oh, okay. Got it.
Yeah, I mean that's a large enough sample. It's not too small. It's not too big. It's totally manageable. Because you're going to be wanting to buy and sell probably the same stock, maybe.
Yeah.
But if you think that you're going to sell this thing and you're not going to buy it back for the rest of the semester, then find another stock to replace it. Okay. So the key to the whole thing is rationale and performance at the end of the day. It's rationale and performance.
Did she tell you about any keywords to put in the?
Yeah, there's like a glossary. Suppose I haven't looked at it yet, but there's a glossary of rationale.
Okay.
That basically lays it out. Plus, I would be calling them too and asking these questions.
Just pull out the buzzwords and put them in the rationale.
Well, there should be, in the rationales, there's a list of rationales. What I would do is copy the definition of the rationale, stick it into your trade, and then edit it and customize it. So use the body of it so that you're nailing it, right? Because they already gave you the definition. Then just re-customize it and edit it so that you're not plagiarizing, but you're still using the content and the key words to basically justify your rationale. That's how I would do it. Okay. That's what I love about this. It's like these projectors never work when you need them to work. I got an equity research position with Dodge & Cox. Anybody interested? I got a sales academy, sales associate position at Cigna. Anybody interested? I got a scholarship through the Urban Land Institute. Anybody interested in real estate as a career? You guys need to take this, you need to apply. And even if you don't get the scholarship, if you're interested in real estate as a career, you need to work with me, okay? Because all these guys know me over there, in all the companies. So with a reference letter, and then going to the Urban Land Institute events, it's totally key. How's everybody coming on the pre-test? Done? Make sure you focus on the modern portfolio theory piece. Everybody has the S&P 500 numbers. You all know what to do with your front tests, your forward tests. January 1st to March 30th, January 1st to June 30th, January 1st to September 14th. Yeah. And then you need to start putting the data in your active portfolio worksheet. You start putting your stock data in there. And then what I did also, oh, awesome. So this morning I spent some time to give you more time in this class. To give you more time to work on the trading, give you more time to work on the analysis, to give you more time to work on the problems, to give you more time to work on the out of the book, is I basically put up all the templates for the class. Okay, so you're not spending the time formatting and producing the documentation. What you should do is give Daniel Kiever $5, you know, for saving you hours and hours and hours of frustration in putting this documentation together. And you should thank some of the other guys too, who built the technical trading system, built the fundamental securities analysis, built the active trading strategy, built the passive trading strategy templates. There was just hours and hours and hours and hours of work that went into building this class that you all are benefiting from. Because you're not developing the class now, you are actually applying a lot of the tools that were developed already by your predecessors over the last year. So you guys are in a really, really good position, and a lot of the frustration that I put these 4 students through over the last year, you won't have to go through, okay? And you should theoretically be able to arrive at basically the trading system, the report, a lot quicker, okay? So you should be able to get here faster than the other classes, because now you have the templates. Okay. So does anybody else want to take a look at what the final product looks like? Okay. And does everybody understand what's due on Monday? What we're trying to do? I want to audit the passive portfolio worksheets. So I want to look at the forward tests. I want to look at the back tests. I would like to review the memo. And if you can, go ahead and give me a draft of the PowerPoint presentation, because that's what you're going to do. You're going to present the passive strategy. Then you're going to present the active strategy. Then you're going to present the target strategy at the end, which is the whole book that you're going to present with the moving average crossovers, with the fundamental securities analysis, with the active, passive, target, portfolio performance. And you're going to wrap that all up in a final presentation in the final book. And I would recommend too that you make a copy, that when you produce, or whoever your marketing person is in your team, when you produce this book, you should make a copy. You should make 3 copies, one for me, and then, or 4 copies, one for me, and then the other 3 for your team members. So you can take that, because I got people who are showing this to potential employers, and they're getting the analyst positions. They're getting the jobs. They're looking at this stuff going, what graduate school do you go to? It's like, we're undergrads in finance at St. Mary's. It's like, we never did anything like that. So it's getting them jobs, okay? All right, so who's making any trades right now? And then we'll get into the chapter presentation. So who's made trades in equity sim? Okay, what was your trades, what was your rationale?
Well, I've only done 8 of my 25.
That's cool. But you started buying and selling?
I've only bought them. I was only doing it.
Okay, anybody else? Did you put rationale in there why you bought them?
Yeah, I just put under diversification that I was diversifying my defense.
Okay. You may want to go ahead and do some just rudimentary Gordon growth, you know, or some PE multiple, and basically justify the buy. So you can just tell them I was using, you know, we estimated the EBITDA, or the earnings per share out for 2019. We applied an 8%, you know, discount rate with a 3% growth rate. We got an intrinsic value using the Gordon growth of $25. The stock's 20, so that's a premium. So that's a justification to buy the stock. Or do you think that you know what the earnings per share or EBITDA per share is? You do an estimate on the PE multiple or PE EBITDA multiple, you apply that to the projected EBITDA per share, earnings per share for next year, and you get an intrinsic value of it, $30. The stock's trading for 25. We think it's going to trade at a 5% premium over the next year. Therefore, we have a buy recommendation for the stock. Don't do the discounted cash flow stuff yet. And I wouldn't use the perpetuity model. I just use Gordon growth and multiple right now as a justification or a technical trading strategy. Either the crossovers or it looks like it's in an upward trend. There's high trading volume. You just come up with some technical rationale, put that in there as the justification for buying the stocks.
They didn't have two of the stocks that we have in our portfolio.
Oh,
So
They didn't.
I don't think they have.
that's fine. I mean, just pick
other ones.
two more. Yeah, don't worry about it. So is everybody clear on the rationale? So on Monday, I'll come around and check. You should be trading and putting it's the labs on Monday, so start putting that stuff in, start coming up with rationale, start putting that stuff into the system, okay? So get started. And then again, I'll come around and look at your worksheets, I'll look at your pre-test, I'll look at your memos, I'll look at all that stuff, okay? And then how long are the presentations today? Who's going? 15, 20 minutes each. Okay. We don't, in this class, in this book, there's no discussion of real estate. Okay? No discussion of real estate. Commercial real estate is about a $10 trillion industry. And so to teach an investments class with no real estate is kind of weird, if you ask me, or insurance. Okay, it's not there. If you're interested in real estate, here are the peer-reviewed journal articles. If you want to do some research, Real Estate Economics, Journal of American Real Estate and Urban Economics Association. These are all the smarty pants people. Okay? And then you have the International Real Estate Review. This is all the American Real Estate Society. Journal of Real Estate Practice and Education. I don't even think we put a lot of this there. Journal of Real Estate Literature. Journal of Real Estate Research. And then the mother of all journals, this is one I published in a couple times, is Journal of Real Estate Portfolio Management. Okay, this one's really good. Okay. And then the books that I'm using right now in my courses that I teach someplace else. The Real Estate Market Valuation and Analysis. This is okay of a book. I don't recommend buying it. Just see if you can get it free online. This book, Real Estate Valuation Theory, this is a little too technical, but it is a fairly contemporary book. It's okay. I would say if I was going to buy a book, I would buy this one, Foundations of Real Estate Financial Modeling by Steiger. This one has all the waterfall systems and everything, so if you're interested in this stuff, I can post the Excel worksheets on there and make this available to you if you want to do it. If you want a job as a mortgage analyst or portfolio analyst or acquisition analyst or equities analyst, this is the book I found that was really, really good. Okay? And then this is a little bit more technical. This is Flexibility in Real Estate Valuation Under Uncertainty by David Geltner, PhD, smarty pants guy from MIT. His stuff is real off the frickin' charts. But again, this was one of the only other books that I could find that would be a nice companion to this one, but if I had a budget constraint, I would just get this one. Okay. And then they have all the Excel spreadsheets. I can provide those to you, so at least you can take a look. If you want me, I can post them on the website so you have them available, so you have some templates to use if you get interviewed for any jobs and stuff. At least you can look through the templates, and if you want, I can integrate it into the class. Peter Linneman just came out with this book, Real Estate Finance and Investments. I think this is a pretty good book. It's easy to read. He's got lots of templates. It's expensive of a book. You can get it for free. That's cool. But I do have the Excel spreadsheets for this one too. And then the Bible that's been around for like 20-something years, and I know Jeff Fisher very well too, is the Brugman and Fisher book, the Real Estate Finance and Investments. This is basically a survey book. It has one Excel spreadsheet It does everything, so it's pretty efficient. This is a pretty good book too. So I think these are the contemporary books and the journals. If you need resources, you're going to go interview. You probably should talk to me first, and then go in, and you'll be prepared as soon as you walk in. But having the Excel spreadsheet is almost mandatory. It really is. It's mandatory. Okay, so that's really all I've been working on. Now I will promise you that I will get you for your memos. Start cranking those out, and then what I'll do is I will finish that model to basically add in the futures and the option contracts, and the options on the futures contracts and where to go trade them, and then hopefully you can take what your memo says, in the direction and trades, and then actually go find actual futures and option contracts and actual options on futures contracts based off some index, and actually find those contracts and then track the contracts. Start simulating some of the trading. Maybe I'll find another derivative trading platform, to take your memos and then do the derivative trading applications to your memos. Maybe I'll do that too. I haven't figured out how to do this piece of the class yet, but I have some time now to do it. I wanted to get your templates up there first, really quickly, so that you could start utilizing those and not wasting time building the formats, but spending most of your time doing the analytics and the analysis. Do you have any questions, Mike, or anything, comments? Okay, so why don't we do the presentations, and then maybe we can get out of here a little early, Friday time. I know Tyler's got a barbecue he's got to go to. Yeah, what I'll do is when you guys present, I'll come around and take a look at some stuff. It's just a joke. One time it was so funny, Tyler didn't show up to class, and Mary Hernandez is going, I don't know where he is. It's like, well, call him right now. Oh, really? Yeah, call him right now. So she's got him on FaceTime, and it's like, Tyler, where are you? And there's like barbecue smoke coming out of the bag. She's going, you got to talk to Professor Susan. It's like, hi, Tyler. Where are you? Pretty funny. Okay, so who's going first? Who's making the presentation? You guys? Yeah, go. And then I'll come around and check your memos, pre-tests, and templates and stuff. Are you guys ready? These are some hefty chapters. And don't rush through it. You can just take your time on it now. And don't forget to speak really loud. Try to yell at these people.
So we're group number 5, and we have chapter 5, which is risk return and historical record. So today we're going to be talking about interest rate determinants, rates of return for different holding periods, risk and risk premiums, estimations of risk and return, normal distribution, deviation from normality, and risk estimation, historic returns on risky portfolios. So some of the interest rate determinants for supply would be households, for demand would be businesses, and then for government net demand would be Federal Reserve actions. So for nominal interest rates, that's basically the taking inflation rates into account before calculating the actual interest rate. So for real interest rate to calculate it, you do the nominal interest rate minus the inflation rate over 1 plus the inflation rate. This is an example of what a demand curve would look like for the equilibrium real rate of interest. And so on here, if like the equilibrium is right there and something causes the demand curve to shift up, then it would also increase on the supply curve. So for the equilibrium nominal rate of interest, as the inflation rate increases, investors will demand higher nominal rates of return. And if the I denotes the current expectations of inflation, then we get the Fisher equation, which is the nominal interest rate is equal to the real interest rate plus the expected return. No. So for taxes and the real interest rate, tax liabilities are based on nominal income. This is an equation, so you do the nominal interest rate times 1 minus the tax rate minus the inflation rate, which is equal to the real interest rate plus the inflation rate times 1 minus the tax rate minus the inflation rate. And so the after-tax rate falls as the inflation rises. For taxes and the real interest rate example, this is just an example one. So you basically do the equation, and for this one you would plug in the nominal interest rate, the inflation rate, and the tax rate, and then you would get about 3.5%. For rates of return for different holding periods, for the zero coupon bond, the par would be 100, the maturity is equal to T, and the price is equal to P, and then you would have the total risk-free return, and you would plug it into this equation. So this is the rate of return is equal to 100 over the maturity price minus 1. And this is an example of one, so this is from our textbook. I think it's one of the homework problems. To find the effective annual rate, you would basically do 1 plus the effective annual rate is equal to 1 plus the rate of return times the compounding periods, and then it would be 1 over T. And then this is the annualized percentage rate, which you would do 1 plus the effective annual rate to the simple interest rate minus 1 over T. And so the difference between the effective annual rate is that for this one you would basically use them for funds that are invested over a 1-year period, and you would basically use the compounding interest rate, and then for the annual percentage rate, you would only use a simple interest. This is an example from our textbook. This is an example. So the way to do this is basically you would analyze it, and then you would see that the moderate interest rate offsets most nominal gain on low-risk investments. A $1 in the T-bills from 1926 to 2015 grew to $20.25, but with a real value of only $1.55. And then there's a negative correlation between the real interest rate and the nominal interest rate, which doesn't fully compensate investors for increases in the interest rate. And this is the graph. So risk and risk premiums, the rate of return for a single period, this is the equation. So we would basically plug that in. So the HPR stands for holding period return. The other one is for beginning price. Next is the expected ending price, and then the expected dividend of period 1. This is an example. For expected returns, you would do the expected returns is equal to the sum of the states times the probability of a state times the return if a state occurs. This is an example from our homework. And so if the expected returns came out to be about 9.76%.
Sweet. So expected return and standard deviation, we've gone over this since the beginning of our class. So the variance, that's the equation, standard deviation, and basically use these two equations to find out the return of the portfolio or that current stock bond. So scenario VAR and standard deviation. So this is an example of how you would use variance. And the answer is 0.038, and then the standard deviation calculation is basically the square root of the variance. So time series analysis of past rates and returns. True means and variance are unobservable. So possible scenarios like one in the examples are unknown. Means and variances must be estimated. Always estimated. Right, Mike? Okay. Returns using arithmetic and geometric averages. Arithmetic average. So arithmetic average, that's the equation. Geometric time-weighted average. Terminal value of investment is TVN 1 plus returns. 1 times 1 plus returns is of the second one, and then you go on. So however many stocks you have. So geometric average, G equals TV, which is the terminal value, minus 1. So estimated variance, expected value of squared deviations. Again, that's another equation. You plug it into Excel, and it pops out. Unbiased estimated standard deviation. Again, another equation. Pop it in Excel, and then the answers pop out. So the reward to volatility, Sharpe ratio. On the Sharpe ratio, we use it for investing. So excess return is basically the difference in any particular period between the actual rate of return on a risky asset and the actual risk-free rate. Risk premium is the difference between the expected HPR on a risky asset and a risk-free rate. It's normal distribution. Everybody knows what that is. So, normality and risk measures. What if excess returns are not normally distributed? Basically, the SCD is no longer a complete measure of risk. So you use skewness and kurtosis. So the skew ratio is basically a ratio on the average cube deviations from the sample average, also called the third moment. And kurtosis, the likelihood of extreme values on either side of the mean. So normal and skew distribution, those are basically two examples of the normal and the skew. You guys can see the difference. So the mean is 6% and the standard deviation is 70%. So that's normal and fat tail distribution. Again, another example. Kurtosis is blue, is 0.35, 35. And then the mean is 10% and the standard deviation is 20. So VAR, so it is loss corresponding to a very low percentile of the entire return distribution, such as a fifth or first percentile return. So expected shortfall, also ES, also called CTE, focuses on the expected loss in the worst case scenario, left tail of the distribution. So that's basically the negative returns. More conservative measures of downside risk than VAR. So normality and risk measures. So LPSD is lower partial standard deviation, similar to usual standard deviation. However, it only uses the negative deviations from the risk-free return. Addresses the asymmetry in return issue. Sortino ratio, the ratio of average excess returns to LPSD. So historical returns on risky portfolios. This is from our book. Just give us an example. T-bills, T-bonds, and stocks. So this is a question to the class. Do you guys think this is a normal distribution of the T-bills and the T-bonds?
No,
No? Why?
because they're like super skewed.
I like it. Good answer. That's right. So you might wonder about the negative T-bills up in the frequency distribution above. The T-bills didn't make their debut, or they weren't really popular until the 1940s. Everything was based off commercial paper because technology wasn't really present. So again, historical returns on risky portfolios, equity markets. So the second half of the 20th century offered the highest average returns. Firms capitalized. Firm capitalization is highly skewed to the right. Many small but few gigantic firms, just because the market was still getting established. Average realized returns have generally been higher for small stocks versus larger stocks. So, Austin, do you think this is normal distribution? Why? normal distribution. With the left and right, basically the tails of the distribution, too low, and the middle too high, so it's not, but it's okay. Historic returns on risky portfolios. Normal distribution is generally a good approximation of returns. So VAR indicates no greater tail risk than equivalent normal. And an example. However, negative skew is present in some portfolios some of the time. Positive kurtosis is present in all portfolios all the time. So, Tyler, do you think this is a normal distribution?
That is a normal distribution.
All right. So basically, the average excess returns around the world in 1900 and 2015. All right, thank you guys.
What were the chapters? What we're doing
We're
today?
doing 7.
What?
7?
6 and 7?
Just 7.
Just 7? And who's doing 6?
Did you?
There you went.
Did you do chapter 6 or 5? What does it say on the syllabus?
6 and 7 today?
What's the team and the,
Really fun.
what does it say on the syllabus? I'm just checking. Anybody got a syllabus handy?
Big group 6 much.
Yeah, it's 5 to 6 and then 6 to 7.
So what team does chapter 6?
Team 5.
What team are you? Looks like you guys are doing chapter 6 next week. Okay. And then who's doing chapter 7?
Us.
Okay, great.
Right now?
Yes, please. Thank you. Thank you. I'll work with you on the chapter 10.
Good effort.
You come by and see me. Yeah. And then, yes, go ahead.
That's a big old group. These Snickers bars are my only sustenance for the day.
Alright, so we'll be talking about chapter 7, which is titled Optimal Risky Portfolios. So the overview, we have the investment decision of capital allocation. It's the apportionment of funds between risk-free investments and risk investments such as stocks, and then the risk-free would be T-bills as an example. Asset allocation, investors may use different asset allocations for different objectives. So, for example, if someone's trying to save a car, they might invest their car savings funds in a conservative mix, like a CD, short-term bonds. An IRA would be more of a long-term investment, so you'd be looking at a risky portfolio. Security selection, so this would be after the asset allocation strategy has been developed. So your securities are going to be selected to construct the portfolio and populate the allocation targets according to the strategy you're going to use. We'll be talking about optimal risky portfolio. And then the Marowitz portfolio, he introduced this idea in 1952. And this model shows that it's possible for different portfolios to have different levels of risk and return. So there's the top three, the top-down process. You have capital allocation, asset, and security selection. market risk is the possibility of an investor experiencing losses due to factors that affect the overall performance of the financial markets. It's also called systematic, and it cannot be eliminated through diversification that would be hedged against. So the sources of the market risk will be like recessions or anything with political turmoil. Firm-specific risk relates to risks that are very specific to a company. They can reduce the risk by diversifying their portfolios. Moving on. The graph on the left is showing portfolio risk as a function of number of stocks in the portfolio. And then panel B is a firm-specific, which is basically all risk sources are independent and your exposure to risk is reduced. This graph is using data on the NYSE stocks. It's showing the average standard deviation of equally weighted portfolios constructed by selecting stocks at a random function of number of stocks in the portfolio. The risk will fall on average with diversification. The expected return on a portfolio is the weighted average of expected returns on the component securities with portfolio proportions as weights. Portfolio risk or variance depends on the correlation between the returns of the assets. And covariance is a measure of the way returns of two assets move together. So this is a formula considering a portfolio made of equity, stocks, and bonds. This is the portfolio variance formula. And the third one is the covariance.
So now we're going to move on to correlation coefficients. So it's just called P. Basically, if you have a rating, the values go between -1 and 1. If you have 1, the correlations between the two assets are perfectly correlated. So what one does, the other one's supposed to do. If they're at 0, then they're completely uncorrelated. If they're at -1, then it's perfect negative correlation. Within a portfolio, if it equals 1, that means there's no diversification. In other words, both assets in the portfolio do the same thing. So it's kind of bad if they both go bad. And then if -1, then you can have a perfect hedge. There's the formula. Figure it out. There's the other formula for the weights, the assets, and then here we should. And then
Press the button.
Oh, that's what I'm calling.
Oh, sorry. I accidentally hit the button in the classroom.
Oh, okay.
Sorry.
Yeah.
okay. This is the 50-50 split for a risky asset. Those are the formulas to calculate the expected return. You just plug in the numbers, you solve it using algebra. And then here's the graph of the two risky assets. There's the formula to figure it out. Here's the graph for the standard deviations. It shows the different P's and what those would look like as a function of standard deviation. So the ones with the straight lines are 1 and -1, so you can see it's a lot easier to predict. The other ones have a curve, so it's not quite as easy to look at. Here's the expected return, same concept as the slide before. And then minimum variance portfolio, basically risk, kind of talking about risk in P. When you have +1, there's no risk reduction because they're perfectly correlated. At 0, it's kind of in the middle, and then at -1, you can have a riskless hedge, which is kind of what you want. Alright, so this is the opportunity set of the debt and equity funds, the two feasible CALs. So you can see the graph. graph here. It shows portfolio A and portfolio B. This is the Sharpe ratio. Maximize the slope of the CAL for any possible portfolio. The objective function is the slope, so it shows the formula there. Here's an example of the Sharpe ratio. So you can see Cal A and B. A is portfolio A, B is portfolio B. And this is the debt and equity funds with the optimal risky portfolio. On the right, you can see the optimal risky portfolio, a return of 11%, and you can see the determination of the optimal overall portfolio. So this is the optimal, what the graph would look like for an optimal portfolio, and again, it's just showing you how to do the math. And then here it shows what the portfolio is made up of. It's 44%, 44.6% stocks, 29.7% bonds, and 25.6% T-bills. Again, that shows the math, how to get these numbers and what they mean. And then the Markowitz portfolio optimization model. Step 1, determine the risk-return opportunities available. All portfolios that lie on the minimum variance frontier from the global minimum variance portfolio and upward provide the best risk-return combinations. Okay. This is the minimum variance frontier of risky assets. The blue line is the minimum variance frontier, and all the dots inside are individual assets. The dot in the middle, on the midline, the global minimum variance portfolio. So that's the one you want.
So for the Markowitz portfolio optimization model, you want to search for the CAL with the highest reward to variability ratio, and everyone invests in P regardless of their risk aversion. So more risk adverse investors put less in P, and less risk averse investors put more in P. And so this graph shows the efficient frontier, and it relates it to the Cal. So you can see P, and it does like a curve off of P. So then you have the capital allocation and separation property. So portfolio choice problem may be separated into two independent tasks. Determination of the optimal risky portfolio is purely technical, and allocation of the complete portfolio to risk-free versus the risk portfolio depends on personal preference. So here you can see the capital allocation lines with various portfolios from the efficient set. So the blue line is the efficient frontier of risky assets, and it goes down the bottom. It's the global minimum variance portfolio, and it connects at P. And the power of diversification, so you have to remember this equation. There was also covariance, and then if we define the average variance and average covariance of the securities as this equation, so you have covariance equals 1 over n times n minus 1, and all that. Variance can be shown as this in a portfolio, and portfolio variance can be driven to 0 if the average covariance is 0. So the irreducible risk of diversified portfolio depends on the covariance of the returns. Here's a chart with like different risk reduction for equally rated portfolios. So all these portfolios are weighted the same, but they have different risk. And then so optimal portfolios and non-normal returns. So fat-tailed distributions can result in extreme values of VAR and ES, which results in smaller allocations. So if other portfolios provide sufficiently better VAR and ES values than the mean variance efficient portfolio, we may prefer these when faced with fat-tailed distributions. So risk pooling is merging uncorrelated risky projects as a means to reduce risk and the insurance principal. And then risk pooling is also increases the scale of risky investment by adding additional uncorrelated assets. The insurance principle is when risk increases less than proportionally to the number of policies when the policies are uncorrelated. And the Sharpe ratio increases. So, as risky assets are added, a portion of the pool is sold to maintain a risky portfolio's fixed size. So risk sharing combined with risk pooling is the key to the insurance industry. True diversification means spreading a portfolio of fixed size across many assets, not merely adding more risky bets. So the long-term strategy would be invest in the risky portfolio for 2 years, and the short-term strategy would be to invest in the risky portfolio for 1 year in the risk-free asset for the second year. And so long-term is riskier, and it can be reduced by selling some of the risky assets in year 2.
Okay, so on Monday we'll go through the, I'll go back through the